Welcome to this month's Passive Investing Made Simple Bootcamp. This month, we're going to talk about understanding the Private Placement Memorandum, often called the PPM. We're going to understand the risks, the returns, and the fine print that protect you. Now, last month we covered the offering memorandum. In the next months, we're going to cover the due diligence. What are those checklists you need to have in place in order to go through the offering memorandum and the private placement memorandum? But as an investor, you need to understand how to read the legal disclosures. I cannot tell you how many times I've put out a deal and for somebody to invest in, and then I get the PPM signed in 5 minutes and returned to me. And that just, I have to scratch my head. That means they didn't read the information. And that is a huge risk when it comes to investing. So, we are going to cover today those different areas that you need to understand about the private placement memorandum, where that information is held, and how to initially start underwriting this information from the very beginning. All right, so you're in the right place. Again, if you want to turn your active income into passive income and long-term wealth, maybe you've tried to invest in a passive deal before, but couldn't get comfortable making the investment, or you've actually invested in a deal and went, oops, I made a mistake. Maybe it was you that didn't read the private placement memorandum, or you're a seasoned investor and you want to sharpen your skills. If that's you, you're in the right place. Now, if this is the first time you and I are meeting, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And this is, if you're watching the video, this is the whole reason why I invest in passive real estate, so I can spend time with my crazy crew here. We are actually in Sedona, Arizona right now, enjoying our holidays. And what has allowed us to be able to do that is investing actively and passively in real estate. I've done the active investing, scaled the portfolio there, but learning how to take our profit and income and turn that into passive wealth has really unlocked those golden handcuffs for us and allowed us to have time freedom, choice freedom, and location freedom. And this is what I love doing, is helping you understand how to do this for yourself, whether you are taking your earned income or business income and trying to scale that passive portfolio. Now, I have documented my journey in my book, Money for Tomorrow: How to Build and Protect Generational Wealth, all of which is to help you replicate some similar results that I've had on getting 100% control and choice on how you spend your time. And if you're interested in learning more about that journey, you can find that on Amazon.com. Or if you want to connect with me directly, you can do so at passiveinvestingwithwhitney.com. There we can jump on a one-on-one call and I can help you align this information you see on these videos and boot camps that I do with your personal investing goals. We can also show you our vetted opportunities and connect you with additional resources and skills building boot camps to help you accelerate your investment growth. Now, let's kick off today's webinar. Okay, we are actually talking about the legal stuff now. Not a lawyer, not an accountant, not a financial advisor. So we are going to stay pretty high level here on defining what the PPM is, what it's not, why you need to pay attention to it, and how to start picking this information apart. Now, I always suggest, if you are investing with a new operator or in a new deal structure, always take the PPM back to your lawyer and invest in an hour or two of their time to help you. They're going to redline the PPM. They're going to ask for changes that you probably are not going to be able to get past the operator, but you are going to understand all the risk associated with that investment. Okay. And that is valuable information. So what is the PPM? Okay. The PPM is actually 3 documents put together. It's going to be the offering memorandum, the subscription agreement, and then the actual private placement memorandum. Okay, all 3 of those put together, we loosely in the space call it the PPM. Think of it as like a prospectus that you would get if you were investing in a publicly traded asset. So maybe you've invested in stocks, bonds, and mutual funds before, in a taxable account or a retirement account. We used to get them mailed to us. Remember the little, 4 by 6 pages that were super thin and like 2-point font. Now we get them emailed to us. Okay, that is the exact same document. It's just most people don't read the prospectus at all. Okay, the PPM is similar documentation. It's going to disclose the legal agreements that we are agreeing to that bind us to this partnership with all the rights, risk, and obligations. It's also going to go through the terms and structures, capital calls, distributions, voting rights, governance of the asset. And then it's going to go through the rules of partnership, how decisions are made, how money flows, and how conflicts are resolved. What the PPM is not, it's not marketing content. This is a legal disclosure document. Okay, it's not designed to sell, it's designed to disclose. It's not a repeat of the offering memorandum. Okay, it serves an entirely different purpose with different details. So this is where my mind gets boggled. An investor might read very thoroughly the offering memorandum and then sign in under 5 minutes the PPM. I know they're two different documents. We got to get good at both. Okay, and it's not optional reading. Okay, because once you sign, it is legally binding for you because you're signing into a partnership. All right. So it doesn't have to be scary either. Okay. Probably just like the offering memorandum, the first few times you read it, you probably scratched your head and tried to figure out what all the information you were trying to impact. But the more you read it, the better you got good at it. Same thing with the PPM. All right. It doesn't have to be scary. Remember, um, we've looked at probably prospectuses with our stocks, bonds, and mutual fund. Now, that's on the thinnest paper you possibly could get in 4-point font, okay? If we expanded that to regular paper, 12-point font, we're going to have a similarly structured document. All right. Why does it matter that we get good at this? Okay. Well, sometimes in certain parts of the market cycle, deal timelines move really fast. Or if you stumble across a deal and you have to get your money in really quickly, you got to get really good at reading a PPM. Again, the reality is the PPM is legally binding. Once you sign, you're in partnership. Okay. Your signature confirms that you understand every detail of that document, not just that you're raising your hand and participating, that you understand every deal. You understand all the risk, the obligations that you're making. You understand how money flows, who gets paid what and when, what happens if the deal goes sideways or south, that you understand all the things that are happening there. Now, the cost of not actually fully understanding a PPM is that you get misaligned expectations. I think this is one of the biggest challenges that I've seen in the past 3 or 4 years is investors have gone into deals and the market has been challenged, the deals have been challenged, and we just have misaligned investors have misaligned expectations. Okay. So we want to make sure that you fully understand all the risk of the deal and what happens. It's not a matter of if or when a deal will go south. It's a matter of when one of your deals goes south. So when I used to have single family rentals, 40 of them. It's not a matter of if you have a tenant stops paying, or if you have a tenant that you have to evict, or if you have to replace a roof. It's a matter of when. So we want to understand what are those risks and those obligations whenever those things do come up. And here's the thing. Um, if you don't learn how to read the PPM effectively and efficiently, you can be a little confusing. What are the roles? What are the distributions? Okay, well, who gets paid what and when? What are the waterfalls here? So we want to shift you from, I hope this deal works out, instead of you looking at this legal document and going, wow, this is so confusing. I'm gonna sign here and I really just gonna cross my fingers and hope that everything works out. I trust you to trust but verify. Yes, I trust you as the operator, but I understand what I'm agreeing to here. So let's get into this. How do we do this? Well, first, I want to start off with let's understand what information is in the offering memorandum, what's in the PPM. Okay. Remember, our offering memorandum is the story and strategy. Okay. It's going to give us the market, Overview, investment rationale, property details and strategy, visual presentations, comparable analyses. It's going to give us all the economic data, the demographic data, local and community impact of that particular deal. It's going to be a beautiful representation of the financials. It's going to lay out the future business plan of the deal and additional investment highlights. The PPM, different. It is legal agreements. All right. Now, the offering memorandum should be included in the PPM. All right. But the PPM is different. The PPM is going to lay out all the legal disclosures, risk factors, security law compliance, subscription agreement, investor qualifications, investor rights and obligations, legal disclaimers, regulatory filings and compliance, and legal contact information. All right. Essentially, the OM tells you why to invest. The PPM tells you how you're investing and what you're agreeing to. So, how do we read the PPM? But remember, there's three different documents here. Okay. So, we got to understand the subscription agreement, okay, the operating agreement, and then the other three areas that we need to be concerned about are actually in the private placement memorandum itself. Okay, the fees, the returns, and the risk assumptions. The PPM should reinforce what was promised in the offering memorandum, not replace it and not contradict it. So, step number one, reading the subscription agreement. This defines who's investing, how much, under what entity they're investing, and their funding timeline. So, this is a very tactical check, all right? Meaning, we're double checking entity names, verifying spelling matches your legal documents exactly. We're double checking investment and amounts, who's putting what into the deal. Okay, you need to confirm your dollar amount and any minimum thresholds that you're agreeing to, and confirm the funding deadlines. Okay, note wire dates and capital call windows. And that will all be outlined in the subscription agreement. Now, the operating agreement is your governance check. Okay, this is going to define who's making the decisions, when are they making the decisions, how is communication happening in general governance of the deal. So you're going to find things like your voting rights. Okay, you need to understand your say in major decisions, say like sales, refinances, capital calls. Okay, that'll all be outlined in the operating agreement. Now, I actually this morning was looking at an online post, and it was a very upset investor discussing a deal that they had been in. And they mentioned that the operator was extremely predatory, had never said that they had never done a capital call. Well, my red flag went up because I was like, I don't think this investor, yes, they're frustrated, but I don't think the investor actually read the document to understand how everything worked with this particular deal. And had they read the operating agreement, asked questions before investing, they probably would have been able to get clearer on how that deal was being governed. Other things that are found in the operating agreement, reporting cadence. Okay, how often are you to receive updates on your deal? Monthly, quarterly, annually? Here's the thing, you're probably going to find a clause saying reporting is going to be done on a monthly or quarterly basis, but is subject to change. Okay, what would impact that change? What is outlined in that particular operating agreement? And then, should the deal run into capital constraints, that operating agreement will also define what the capital call language is for the deal, how and when additional funds might be requested for that deal. All right, step three, fees. Now we're getting into what's in the private placement memorandum. Okay, now this is going to, cover some just basic, very deal specific risk and disclosures here, but one of the big things that we want to focus on are fees. Fees show how the operator earns and whether interests are aligned or not. So to decode the fees, there's a few different buckets. Okay, there's probably 6 or 7 different fee structures that you could have for a deal. Now, this is different than the waterfall. These are actually monies earned for exchange of a service connected to the deal or the asset management of the deal. So the first one is acquisition fee. Okay, this is generally paid at the purchase or at closing of the deal. And it's about 1 to 3% of the purchase price of the deal. So this goes in, just remember, we're investing passively. So that operator has all the expenses connected to finding the deal, underwriting the deal, doing the due diligence on the deal, fronting monies for um, inspections, closing costs, all of that. And also all of the deals that they didn't do, okay? Or the deals that fell through. So this fee, acquisition fee, generally is what keeps the lights on for the business so the operator can actually continue to find more deals for us as the passive investor. Okay. Another fee that is generally charged to deals is the asset management fee, meaning it's an ongoing fee for operations, and it's usually about 1 to 2% of revenue, not asset value. Okay, well, we would like to see that 1 to 2% of actual revenue generated. And it's generally paid annually. So it's an annualized fee. So they might take it on a monthly basis or a quarterly basis. I have seen deals where it's 1 to 2% of asset value. So red flag there. Watch out for that. Disposition or refinance fee, that's generally paid at the sale of the refinance of the asset. And I typically see that at 1%, maybe as high as 2% of the refi price or the disposition price. And again, that fee is generally used to offset all of the sale expenses that go into the deal. Other fees that you might see, two key ones that I see quite often, if there's a construction or a value add component to the deal, you'll probably see a 5 to 10% fee. Um, but moreover, if there's no construction or no value add component, make sure there's no construction fee. Okay. And it should only be on the budget, construction budget, not the overall asset price. And another one is key partner fee. In order to secure the loan, somebody has to pledge a balance sheet in order to get that. So it is totally understandable, whoever is pledging their balance sheet for the deal, that they probably are going to get another 1 or 2% fee, key partner fee, in order to close that deal. Now, here's the thing. Rule of thumb, the fee structure should help the operator run the investment on the behalf of the investors. Okay. If they're poorly structured, the fees actually can drain investor profits. So we want to make sure the fees are reasonable and aligned and just help the operator run the underlying business. That way, you, as the passive investor, can actually invest in the deal. They're not meant to get, I will put it this way. We don't want a deal feed to death just so the operator can collect fees. Okay, we want to make sure they're aligned. Step 4. And again, this information is found in the PPM, returns and waterfalls. This confirms how the money will flow through the deal. Okay, preferred returns, any investment hurdles, general GP catch-up, if any, and additional splits. So this is the follow the money check. Okay, who gets paid what and when? Now, the first hurdle that we usually see, a lot of investors mistake it for a return, but the first hurdle is going to be the preferred return if there is one on the deal. Okay, now some operators get rid of this in order to simplify a deal. Other operators like keeping it in there so it creates a more alignment with the limited partner. But the preferred return generally is a return paid to the investors that the LP gets paid first to a specific target, like 7% or 8%. Now, that's not to be confused with cash on cash. This is an investment hurdle. That means the operator has to clear the hurdle before they get to participate. Now, number 2 is the general partner catch-up. This is where you might see a clause in the PPM that allows the general partner to recover their share of the preferred return before they start splitting profits with the limited partner. Now, personally, I don't like seeing GP catch-ups in deals. Okay, I want to keep very much aligned. I want to make sure that I'm aligned with the general partner in the deal. I'd like to see those removed. Now, profit split, this is where um, who's making money when, okay? If the preferred return hurdle has been cleared, if there is one, this is how the remaining profits are going to be divided. All right. Are they going to be divided with the limited partner 80-20, 70-30, 60-40, 50-50? This is what the operator's trying to get to is this part of the hurdle, this part of the waterfall, because this is where the operator makes their money. Okay. And then you get the exit distribution. Okay. What is the final waterfall upon sale? Okay. So the preferred return, GP catch up, and profit split are during the operational hold of the asset. And then you might actually have a different waterfall structure upon sale. Okay. So the waterfall in one line is preferred return, catch up, hopefully not one there, split, and then exit. If you're not clear on this, ask questions if the sequence or the percentages are not clear for you. The last part that we want to double check in the private placement memorandum are all those risk and assumptions. Okay. Every PPM will outline potential variability, and a lot of that is mandated by governance agencies like the Security and Exchange Commission. It's there to protect you and give clarity, not to scare you. All right. So we want to make sure one is all the legal information there. The things that the Security and Exchange Commission are, the operator is bound legally to disclose to you. We want to also see all the additional risks that could go on with that asset disclosed to you. And then what happened? We also want to see other risk disclosed. And some of the risks that you might see here is rent growth assumptions, like, okay, this is what could happen to the deal if we don't achieve our business plan of rent growth. Or if interest rates change, this is what might happen in the environment. Or if inflation takes off, this is what might happen. Or if we have another COVID epidemic, this is what might happen. Okay, again, all those things are put in place more not just kind of like a CYA type thing for the operator, but to disclose to you as the limited partner that there are risks to investing. And you should know those and understand those and go into it with clarity that you understand those risks. And if you have questions about that risk, if you have questions about how the general partner is mitigating those risks, okay, all that risk mitigation should be outlined in the offering memorandum, okay, then ask. Always ask before investing. All right, so here's kind of our wrap up 5-question confidence test here. Okay, before you sign, do you understand how you get paid? Do you understand the distribution timing, the preferred return, the waterfall order? Do you understand how the operator gets paid? All the fees that go into the deal, the promote structure, is that clear to you? Do you understand the waterfall timing and the order? So as you move through the deal, do you understand who gets paid what and when? Do you understand the reporting and governments? Does that make sense? The communication cadence, your voting rights, are those aligned? Does everything that you read match the offering memorandum? Okay, we want to see consistency between the marketing documents and the legal documents. Now, little side note here, usually the private placement memorandum, lags a little bit in timing after the offering memorandum. Okay, it is not unheard of to have like a slight discrepancy, but you want to make sure that offering memorandum that is going into the private placement memorandum is the one that you've seen and is clear and aligned with the private placement memorandum. So when should you ask questions? Okay, if the OM and the PPM don't match, okay, it could just be a timing issue, or it could be something deeper. Okay, we want to get clarity on inconsistencies. If the fees are unclear, definitely ask. Okay, we want to we don't want you to be confused by stacking or timing. And then if the waterfall feels really complex, like if there's multiple tiers, multiple hurdles, have a conversation with the operator about this before investing. All right, wrapping up on today's webinar. Remember, this is to be paired with the offering memorandum and taken into our future due diligence. Today we learned what the PPM is and how to read the major sections, okay? Because we want you signing with clarity, okay? Hope is not a strategy, okay? We want you signing with clarity. So make sure to use the framework, apply those 5 steps that we just covered today. That'll help build confidence, okay? So you can enter these partnerships with clarity. And most importantly, take your time, all right? Professional investors get really good at reading documents, getting all their questions answered, and making sure that they understand the deal before they invest, okay? You deserve to understand this. All right. If you want to learn more and you want to jump on my calendar to understand how we can help you meet your investing goals, check me out at passiveinvestingwithwhitney.com. All right, guys, if you're here live, don't go anywhere.